All right. The next column we have here is the amount of dividend that these companies pay. So, in our sample company here, ExxonMobil, Exxon pays a $3 dividend per year. So that's $3 per share. So if you own 10 shares of ExxonMobil, then you will receive $30 a year for those shares. All right. The next column we have here is the purchase price. And this is not a realistic purchase price. This is actually the price of this company at the end of December 2015. And so every year at the end of December, I update all these prices so that in January of 2017, this purchase price will then be the price of ExxonMobil December 31st, 2016. All right. The next column is the current price. This is the price as of maybe a couple days ago. I haven't updated this in a while, but all of this stuff is connected to the internet. Once I update it, the price automatically changes. And this is the dividend percentage. This is what we're really concerned with. What this is telling us is that $3 divided by the current price of $86 is 3.47%. So if I were to purchase this stock for $86, I'll get an automatic 3.47% return on my money. Okay, that's what that means. This next column is a bit more trickier, but what this is this is the average monthly return over the past 3 years ending December 31st, 2015. So if you take December 31st, 2015 and you go back all the way to December 14, December 13, if you take an average every month for those 3 years, this is the number you get. And for ExxonMobil, looks like it's a negative 0.359%. Okay. The next number is volatility. We discussed this a little bit when we talked about risk and how to put a number on risk. And this is a standard deviation for the price movement in ExxonMobil over the past 3 years, again, ending December 31, 2015. And we see here that the price moves up and down about 6% for that stock. All right, the next column is price to earnings ratio. This is really important. This is a number that you'll actually hear mentioned on all the financial talk radio shows and all the not advertisements, I'm sorry, in the newspapers and financial magazines and things of that nature. And typically what you'll hear people say is, oh, the PE ratio is too high, or we really want this stock because the PE ratio is really low. Well, what the PE ratio is literally price divided by earnings. Okay, and so when you do the math on that, what that means is that if you have a positive number, if you have a whole number here, that means that the price is actually larger, okay, than the earnings, because the earnings divided into the price is a big number. Okay, so the higher the price, the smaller the earnings, the higher this number is going to be. Okay, the lower the price, the bigger the earnings, the smaller this number is going to be. And when we purchase a stock, what we want a company that has really great earnings, okay, but we don't want to pay a lot of money for the stock. We're looking for cheap stocks. We're looking for cheap stocks that make a lot of money, okay? Now, understand that you cannot look at a PE ratio number on its own and determine whether or not this is a good buy. It doesn't work that way. What you have to do is you have to look at this number in reference to the other companies that are in its industry or in its sector. Okay, for purposes of my portfolio, I prefer to look at other companies within the sector, not necessarily the industry. Okay, so in reference to the rest of the sector, that'll tell us whether or not this company right now is either expensive or cheap compared to its price and earnings. All right. The next number is going to be our net profit. Okay, we talked about net profit earlier, and net profit, as you remember, is revenue minus all your expenses. Net profit is what you have at the end, and what this number represents is the change year over year. So we're looking at 2013, 2014, 2015, and what we're doing is here we're calculating the difference between the profit of 2013 and the profit of 2014. Okay, and then we calculate the difference between the profit of 2014 and 2015. We take those numbers, we add them together, and we divide by 2, and that gives us the average change of the net profit over the last 3 years. Okay, and as we can see here for ExxonMobil, on average their net profit has declined 25% over the last 3 years. Okay, and again, this number cannot be taken on its own. It must be compared to the other companies in its sector or its industry in order for it to even make sense. Understand that if all the companies in the sector are losing money, it doesn't mean that this is a bad stock. It's very possible that this stock has lost less money than the other companies in the sector, which makes it a great stock, right? In contrast, what happens if maybe this company is losing more money than the rest of the companies in the sector? That's something that we'll have to look into. All right, so the next column here is assets over liabilities. This is typically called the current ratio. My calculation is a little different than what you'll see on Yahoo Finance or in some of the finance books that talk about current ratio. The reason being is because instead of using current assets divided by current liabilities, or a quick ratio, which uses cash divided by current liabilities, what I like to do is I like to use the current assets divided by total liabilities. And what that simply means is all of your assets that you can quickly turn into cash, I want to know how much of those assets can actually pay off all your liabilities. Okay, that's what I want to know. And so for our sample company here, it looks like 30%. So what that means is all of the current assets, all of the things that can be quickly turned into cash, can pay off about 30% of the company's liabilities. Okay, and again, this number cannot be taken on its own. However, I can say that typically what I like is a company around 50%. Okay, I really like to have 50% of the liabilities being able to be taken care of by the current assets is an ideal number for me. And that goes also for individuals as well. When you have more liabilities than you have assets, that makes you insolvent, right? And what we want to do is we want to have more assets than we have liabilities. And we can go further into that at another time. So the next number we have here is cash per share. Okay, and what this means is if you take all the shares of the company and you take all the cash of the company, what I want to know is what percentage of the share price is made up of cash. Okay, and for this particular company, ExxonMobil, only 0.48% of one share is made up of actual cash. The rest is made up of assets, earnings, and future earnings. All right.